Thank you, Mr. Chairman. Strong, competitive, and perhaps most importantly, accessible capital markets are essential to fostering a healthy entrepreneurial ecosystem and the U.S. economy. That's why the passage of the Jobs Act, Mr. Quadman, as you said, 10 years ago was a game changer, a game changer. Lawmakers recognized that there was nothing partisan about making it easier for our country's companies to spur innovation, hire new workers, invest in their communities, and power U.S. economic growth, and work together on a bipartisan basis to pass common sense legislation aimed at doing just that. And now, as our economy looks to complete its rebound from the impacts of the pandemic, this body is presented with an opportunity to build on the enormous success of the Jobs Act, and once again, to jumpstart capital formation and the creation of good jobs by companies that serve as the lifeblood of the American economy. The Jobs Act's creation of Emerging Growth Company, or EGC, status to provide a flexible regulatory regime for small companies that are still working to scale their businesses has been a resounding success. Case in point, and since 2014, roughly 90% of companies have gone public using the EGC status. Mr. Quadman, EGC designation has made IPOs more attractive for low-revenue, high-growth companies by smoothing the transition to the public markets without compromising investor protection. However, some companies, like biotech firms, have long product development timelines, reached the end of their 5-year exemption limit, and still aren't generating enough revenue to support the much steeper compliance costs that come with a loss of EGC status. How would my legislation extending the EGC scaled regulatory regime to 10 years benefit companies and the broader economy?
It does two very important things, Senator Scott. Number one, it allows regulations to be tailored to that company, right? So if you take a biotech firm as an example, right, they have very heavy capital needs, but they're not necessarily selling anything yet, right? So if you take a look at, let's say, all the controls around revenue, they just create costs with no meaning. And in fact, what those extra dollars do for regulatory compliance, which is meaningless, actually takes money away from research as well as job creation. Number two, what it does, it allows those companies actually to grow into the appropriate levels of controls and process that are needed to have the certainty that they do need when they do reach their full-bloom public company status. So it allows for a greater ramp up because, quite frankly, with those innovative firms, 5 years isn't long enough and 10 years is a better time frame.
Thank you, sir. I look forward to working with my colleagues to build bipartisan support for this common sense legislation. U.S. capital markets are the gold standard globally and help make the American economy the envy of the world. They provide a system where the average American working family can invest their savings into projects and earn a tangible economic reward, enabling their dreams of buying a house, sending their children to college, and retiring with economic security. A little over a year ago, I sat right here and had a conversation with SEC Chair Gary Gensler about the significant ways the retail investment landscape has evolved over the last couple decades, and discovered that we both strongly agree on one point in particular: increased retail investor market participation is a good thing for America. Now, it's not that often that Gary Gensler and I find common ground, and that point would be supported by Chairman Brown if he were here. So it was encouraging that we both seemed to see eye to eye about the benefits of more people finally beginning to gain access to this powerful wealth-building engine. Do you agree with that statement? And is more Main Street investors getting involved in the market a positive thing?
It's a very positive thing. So allowing Main Street investors to enter into the marketplace creates wealth on Main Street, right? So the problem that we have seen over the last 20 years or so, many of the capital raising measures that are happening are only happening in 20 counties in the United States. So we've actually seen a calcification to some degree of our marketplace. What the Jobs Act did, and one of the reasons why we think that it is important to do additional amendments to it, so let's say with crowdfunding, the credit investor rules, expanding those, it will actually allow for retail investors to have more opportunities to create wealth. And it can be done in a particular way that will actually strengthen investor protections. And frankly, if the SEC is on the job, that should not be a problem.
Thank you, sir.